Bitcoin to fall and slingshot past it in multiples. But that's my personal expectation this time, because I think the money that they're going to print is going to be substantial. If we get another 100-year event, like one of these things that happens, like 1987 Black Monday, or 1998 long-term capital management, or the tech bubble, or 9/11, or like these 100-year events seem to happen every 3, 4, 5 years, right?
Yeah.
But the next one that happens, likely some sort of credit event, yeah, you'll get a big print. They won't print $5 trillion. They'll print 10 trillion, 15 trillion, who knows? I'll give you $100 of US dollar, I'll give you $100 bill, or I'll give you $100 of Bitcoin. What are they going to take? They're going to take the $100 almost every single time. They're going to be, oh, I want the $100, because they have extremely high confidence. They don't understand Bitcoin. They don't know what it is. They don't so
yeah.
The confidence it's going to take a very long time, in my opinion, to break that, or something that is just absolutely catastrophic, like we talked.
The mainstream crypto media will not show you this. They're too busy covering price action, ETF headlines, and whatever shitcoin is trending on Twitter today. This channel identifies individuals who are 3 steps ahead of the market. The analysts, investors, and fund managers who were positioned before the rest of the market woke up. Subscribe now and get early access to the thinking that moves big money before it goes mainstream.
James Lavish spent 30 years in finance. He runs a Bitcoin hedge fund. He sits on the board of a Bitcoin Treasury company. And when you ask him what the US government is going to do about its debt problem, he doesn't hedge. He doesn't say it depends. He says there's literally no other choice. What you just heard is not a fringe take. This is a guy who has been inside these markets his entire career, who understands the mechanics of the Fed, the Treasury, the bond market, and what happens when all 3 are moving against each other at the same time. And here's what makes this conversation different from everything else you're going to watch today. He's not just telling you the system is broken. He's telling you exactly how the break happens. The sequence, the thresholds, the triggers. And then he tells you which assets survive it and in what order. His Bitcoin call is specific. Gold moves first, Bitcoin follows, and then, his words, it slingshots past gold in multiples. The money they're going to print, he says, is going to shock people. We're going to hear him build the full case right now. Pay attention to the 4-door problem. That's the part most people miss. Because once you understand it, the whole macro picture stops feeling complicated and starts feeling almost inevitable. Here's James Lavish.
And that is apparent across the world. Demand for treasuries is definitely lower. And you've seen central banks turn around and buying gold. We saw it for over the last, in 2025, the amount of gold that these central banks are buying. I wrote a whole piece about it. Was, it was extremely high levels, near all-time high levels for those periods. They were buying gold, and let's just be honest here. Back when when Russia invaded Ukraine, I believe that we made a catastrophic financial mistake in the U.S. And what we did was we froze the Russian assets and we kicked them off SWIFT, basically the payment system. And so by doing that, by freezing and seizing basically their U.S. treasuries, we told the world that if you do something that we don't like, then we'll just take the treasuries from you. We'll seize our treasuries. And so, just think about how catastrophically, that was a mistake that may not be able to be undone, because soon after that, you had Putin out there publicly saying, why would I want to own treasuries when they can, first of all, they can just seize them. And second of all, even if they don't seize them, they print so much money, they're not worth anything. When I actually get paid back from them, why would I want to have those dollars that have been devalued so severely over the course of the life of that bond? And so that kind of caused all of those BRICS nations We heard a lot of noise about 2 years ago, if you remember, about the BRICS are going to come up. For the listeners, the BRICS is it's a cohort of nations: Brazil, Russia, India, China, and South Africa, that were basically saying we want to have our own currency. That's what the rumor was. It's not really that. They just wanted to find a way to not rely on U.S. treasuries. And that was really the kind of the impetus there. But now you're seeing it. That you're seeing China and Russia and India, and they're not buying as many treasuries as they had before. And I think that was a big part of it. And the second thing was, they're not dumb. They saw that we printed $5 trillion. And that expansion of the money supply has caused great inflation here that has caused the dollar to be, worth less. And even though it's likely it's debasing slower than most other currencies, it's still debasing. So the Fed, they have two tools. They have dual. Okay, let's back way up. So the Fed has two mandates. They have a mandate for stable pricing, which is what they describe stable pricing to be is 2% inflation rate. Mm-hmm. However they come up with that is just nonsense, but that's what they claim is healthy for the economy. And then the second is full employment, which is who knows what that is? And they don't really have a gauge for does it feel like full employment? Yeah. But anyways, so what are they doing? First principles, when you just get to first principles, what is the Fed like? What is their purpose? The purpose is to maintain confidence in the U.S. dollar, in the currency. And that's really what it is. Okay, so why are they doing that? Because the U.S. Treasury has to borrow. They have to sell treasuries in order to borrow because we run at deficits, right? So now they set policy on rates. So they have two tools to do this, to kind of manage the expansion or contraction of the economy. So if it gets too hot, they want to kind of keep it from getting too hot so inflation doesn't get out of control. If we go towards a recession, they want to kind of boost it by making money a little bit easier to get. And they do that through two different ways. And the first way is just raising and lowering the Fed funds rate, right? And so when people look at this and they say, well, they got to lower rates, and you hear even mortgage bankers who don't really truly understand the Fed policy, they'll say, well, they got to lower rates because we need the mortgage rates to come down. That's exactly what you just said, is they can lower rates, but that does not mean that the mortgage rates are going to come down. They can lower the Fed funds rate. All that is doing is giving the target for the overnight rate. And really what all the consumer rates are keyed off of is the 10-year Treasury. Whether it's credit cards or auto loans or mortgages, they're keyed off of the 10-year Treasury. Now, who sets that rate? The bond market. The bond market itself is the one that's setting that rate, and it's through just simple supply and demand. If there's way too many bonds coming to market, then buyers are going to back off and say, well, I'm going to demand more yield for this because there's an onslaught of this, which is what you see with the rise in deficit spending. You see the buyers backing off and saying, we need a higher rate here because deficit spending in and of itself is inflationary, and they expect inflation long term from that. Mm-hmm. So James, when you're watching,
what if the Fed steps in and starts buying $100 billion a month?
Well, there you go, and that's the second tool. The second tool is QT, which is buying and selling securities themselves, entering the open market. The Fed doesn't do it technically. They use banks to do it, but then they move money around on their balance sheets in order to make it go back on the Fed's balance sheet. Mm-hmm. And what does that do? And this is the biggest part of all of it. So rates get a little too high, and so it's bad optics. It's bad optics for the government. It's bad optics for the Fed. And then Trump is yelling at the new Fed chair, and he's saying we need to lower rates. This is crazy. The mortgages are too high, and they're like, we're not setting that rate, And so what do? They go out there and they come up with some brand new acronym, something fancy that says, kind of like they've got this new regular Treasury buyback program that Yellen put in place. Come on. There's nothing regular about a treasury buyback. That's all they're doing is injecting liquidity into the system because they've got these bonds that aren't active, and they take the inactive bonds out and put the active bonds. So it's just a little bit of a shell game with putting more money on the board. And so basically what they can do is, like you just said, they'll buy US Treasuries. They'll go out there in the market and they'll buy them. And they'll use some fancy acronym and some reason behind it, but they'll be out there actively buying these things. And why would they do that? In order to keep the rates lower. And when they do that, what happens? More money comes into the system. So it basically disguises the fact that you've got high inflation while you've got low rates. So you'll have the 10-year come down, which will bring auto loans and mortgages down. And then economy will be going as more money is going into the system. And this is like the only play that they have. Well, what does that create? It creates a larger nominal GDP because there's more money on the board, which means that they can tax more, which means that the tax revenue is higher, which means that they can use that higher tax revenue to manage this debt load that's already at $39 trillion. So it'll be 40, 42, 44, but it won't go to 50, 60, 70 because they're going to have more dollars on the board to manage it down. However, at the same time, all that happens, what happens to asset prices? Gold, silver, Bitcoin, houses, real estate, stocks, they all go up in value, which is not really what they're doing. They're actually a mirror reflecting the debasement of the dollar that's going down in value. And it's just taking more of those to buy that scarce asset. And so that's the ultimate play. Well, first of all, I also, and full disclosure, I'm a co-managing partner of a hedge fund called the Bitcoin Opportunity Fund, and we invest in Bitcoin and Bitcoin adjacent companies. And so, I'm extremely bullish on it. And our largest position is MicroStrategy. And so, and I understand what he's doing and how Michael and Fong Li are going about their business and how they're creating this. They're accreting Bitcoin to their balance sheet for shareholders. And so, if you're someone who understands Bitcoin and wants to have a little bit more exposure to it by using the capital markets and market instruments, then that's a way to do it. And they've created this system where they can basically. They're using the capital markets. It's not really an arbitrage as much as they're using the capital markets to issue these perpetual preferreds that they're paying an interest rate on, a very high interest rate on, and then turning around and using that capital to buy Bitcoin for their balance sheet. And so, they've got massive amounts of coverage, on more than 5 times coverage on their balance sheet for the underlying for their obligations. I think what happens is you got to have a couple things that occur. That it is alarming to see the 10-year jump. It can come back down pretty quickly though. So what is alarming though is the impact to that on the entire economy. Because like we just said, everything is keyed off the 10-year. And if you want to issue debt and you're a U.S. company and you're going to borrow, you're borrowing off the 10-year. If you need bank debt, for your listeners, what does that mean? When you're a large company, you get a line of credit from a big bank, but that's going to get keyed off of what? The 10-year. Yeah. And so, it just makes everything more expensive, which compresses margins, which compresses the profitability, which compresses what? The profit ratio, the PE on stocks, and so you see stocks come down. So the higher the borrowing, basically the lower the PE, and then stocks start to come down. And Trump loves the stock market. He talks about it all the time. You remember his first term, he talked about it almost every single day. And it's his benchmark for success, right? And so, look at where the stock market is. So what happens is you either have a sharp drawdown in the market, in my opinion, because rates just start spiking, and then it spooks investors big time. And then you have a sell-off. You have either a dip or a crash in the market. That could be one thing. Another thing is you could just see something break in the credit markets because of the rise in the yields. There could be just the need for dollars. It could be some sort of, like, if you remember in 2019, we had a repo crisis. There was a great need for dollars. That just weren't enough around. And so you saw the overnight rate spike to 8 or 9% intraday, which was just mad. And so the Fed stepped in and started printing money. Literally, they stopped QE and started stopped QT and started QE within 2 days. It was crazy. And so you could see something like that. But is there a line in the sand? I think barring something breaking to get ahead of it, I think at 5% they start getting a little bit nervous. 5.5% they start getting really nervous. 6% they know they're in trouble. And I think that they will be stepping in before that. The Fed and the Treasury, figuring out how to come up with some fancy acronym to save the market. That's my guess. I call it the four-door problem. You can either have austerity, like Greece was forced into back after the great financial crisis. You can either have austerity where you just stop spending. You cut programs, you cut Social Security. I mean, where are you going to cut? The problem is structurally, we've got so much just structural spending that's in legislation that you literally have to pass laws to change the spending in order to get to surplus. It's not possible otherwise. So they'd have to cut Medicare, Medicaid, Social Security, something in order to get there. Okay, never going to happen. Neither party's going to do that. Or you could raise taxes, which is the second door, which, that's super popular if you're going to raise taxes on billionaires or whatever, but, it still doesn't get you there, because the reality is if you raise taxes on the so-called rich, it's likely going to hit a lot of small businesses, which is the lifeblood of the United States. It's not just the Mag 7s, And so you get to this point where you have you've seen the Laffer curve, where you have rising taxes, and they get to a level where they kind of top out. And because it starts to hurt productivity, because businesses aren't reinvesting in profitable lines. They aren't hiring people. They aren't expanding into new lines of business. And so it actually ends up being worse, because now you've got this high tax rate that you're getting the same that you were before, because your revenues are declining, because companies are not able to make as much money. And now it's even worse, because now you've got declining revenue and a high tax base. And that's bad. So that doesn't work. The third thing is just default. Just default on your debt. Say, you know what? We have $39 trillion worth of debt. We're going to pay you 30 cents on the dollar on that. And then we're just going to be done with it, and we're going to start over. Well, you can't do that, because you'll never have anybody buy your debt again. And that's what happens you've seen it happen in countless Latin American or emerging markets, where they just stop paying their interest, or they reset it. And then what do they have to do? They have to issue debt in another currency like the US dollar. And so, no nation, to quote Lynn Alden here, no nation who can print their own money and is issuing debt in their own currency would ever default on their own debt. It just doesn't make any sense. So what do they do instead? The fourth door, which is print more money, buy your own debt, and keep the engine going by debasing. Just keep printing money and debasing the dollar. And that's literally, it's a daily default. Then most people don't talk about it, but it's a daily default on that debt. It's not the same. You're not living up to your obligation.
So here's where we are. James Lavish just walked you through the whole machine. The Fed has two tools. Neither one fixes the actual problem. The bond market is setting rates now, not Jerome Powell. And the US has $12 trillion rolling over in the next year, at rates that are going to cost more than double what they cost when that debt was issued. The four-door problem is real. austerity, raise taxes, default, or print. 3 of those doors are locked. The 4th one is already open. It has been open for a long time. The only question is how wide it swings. His call on the sequence is what you want to hold on to. When the Fed steps in and the printing starts, gold moves first. That's the historical pattern, and he's sticking to it. But Bitcoin follows, and he says it slingshots past gold in multiples. That's not a vague, bullish statement. That's a guy with 30 years of institutional experience, a Bitcoin hedge fund, and a board seat at a Bitcoin Treasury company, putting his conviction on the record. The amount of money they print next time is going to shock people. That's his phrase, not ours. If this video gave you a clearer picture of what's coming and what to do about it, hit subscribe. We go deep on these conversations, so you're not catching up when it matters. Drop your take in the comments. We'll see you in the next one.